Can you explain what a stonking small cap is?
Stonking small cap is the name we've given to a small company that is growing fast. And when we say growing fast, it's doing at least double digit top line growth. Not
Mm.
three earnings, but its top line is growing at a double digit. And we call it a stonking small growth. So in a nutshell, it's a very fast growing smaller quoted company. Typically, it will be on AIM, and it might be on the main market if we can find one. But I think all of them now are on AIM. And two announced this week fantastic results. One has been a consistent performer, and it's actually due to move to the main market. It's been a fabulous performer, really fast growing. The other one has only just turned profitable, but again, growing very quickly.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello, Lee. Good to be here, as always.
Wonderful, wonderful. Another jam-packed episode, as usual. We're going to discuss car manufacturers, Mercedes and Chrysler. Next, Unilever, Hostelworld, Electrical Contractor T Clarke, M.P.Evans, U Group, Jusges Scientific. But first of all, we're going to discuss UK inflation. A little bit of light at the end of the tunnel.
Yeah, it's fallen to its lowest in more than 2 years. So that looks positive. So there's probably going to be pressure on interest rates coming down. Consumer prices rose at an annual rate of 3.4% in Feb, down from 4% in January. So hopefully Bank of England more inclined to ease those interest rates that are hurting a lot of people.
Yeah, and of course, lower inflation potentially means lower interest rates, which then leads to a higher stock market, which is what we're seeing.
Yeah, absolutely. Well, of course, the S&P 500 hit the all-time high. But then at the end of this week, we had the FTSE 100 closed at 7,930, not far short of its all-time high of 8,047 a year ago, February 23. But I look back and I thought it'd be interesting to see what the 5-year return of the FTSE 100 was, the UK stock market, the main UK index, against the S&P 500. Broadly, in 5 years, the FTSE 100 has returned just a little over 7%, whereas the S&P 500 has returned 78%. Admittedly, that excludes any dividend income, and the FTSE is a much bigger dividend payer than the S&P, but that is stark. That difference is huge, and it's no accident that most investors, institutional investors, have been reinvesting in the US, which has driven returns. And that's why pension funds, UK pension funds, are holding what? I think it was quoted only 4% of their assets in UK equities, which is minuscule compared to what it used to be.
It's right there, isn't it? The reason why that these pension firms don't actually hold so many UK companies, that the numbers speak for themselves.
Yeah, sadly. And all the excitement's been in the US. They've got some great businesses. Many of them are in our ultimate stocks portfolio, which has performed fantastically. Our investment firm Fundamental has also, their general portfolios hold US stocks, and they've done really well and helped drive returns as well. All the big giants where you can't really go far wrong with them. Easy companies to understand as well. It's so easy to understand a lot of these big US giants.
Yeah, we're going to touch on Apple as well, aren't we? So Apple's also, though, just had the DOJ's investigating them for the mobile phones, haven't they?
Yeah, Apple's being subjected to two somewhat unusual claims, lawsuits. One of them is a lawsuit, the first one, which seemingly quite frivolous, is arguing that AirTags are being used. It's AirTag products, which are really nifty, are being used by stalkers to track their victims. A judge rejected the tech giant's efforts to have the class action complaint dismissed. He said it should be heard. A lot of other claims were dismissed, but that seems indicative of the very litigious nature of the US, really, to have that claim heard. However, it's the bigger one that's really everybody's talking about now. The US Department of Justice, along with 16 state and district attorneys, is now suing Apple for allegedly using its power in the smartphone sector to quash competition and limit consumer choice. And this could be a big one. I mean, this is going to drag on and on. Clearly, the only winners at the end of the day are probably going to be the lawyers. Apple's called the lawsuit wrong on the facts and the law, but this is a real big one. And it's just another sort of claim against big tech by the US administration. And of course, the EU as well is going after big tech again and again, whether it's Apple, Alphabet, Amazon. These tech groups seem to absorb this stuff, and they've got so much cash. They've got big legal teams. They bat out the claims forever and a day. But yet these are vast sums of money that don't seem to matter too much. But this one could be quite a tricky one if it's found against Apple.
Yeah, I think it depends on whether they actually break up the current business model that Apple deploys for much of its cash revenue, or whether they actually just do another fine. If they do another fine, Apple's probably going to be okay, aren't they? So
Yeah,
it,
you're right. They can absorb fines. It's more, I think the greatest risk here is that looking at the Apple's services business, which makes an awful lot of money,
Mm.
all the little added bits, the storage bits we pay for, the Apple pays, all these start adding up to a huge amount. And the Apple service business is an absolute monster now. So if that gets impacted, it could be a little bit tricky. You're right. Fines, they seem to be able to absorb.
Yeah. As we've got a lot to cover, should we move
Yep.
on to the next topic, which is going to be car automakers? Now, these are some of the cheapest stocks on the market, aren't these? But is there a reason why they're so cheap?
There is. What drove me to have a look at these, and I've looked at automakers a lot, and they look superficially cheap. And what drove me this week to have a look is Mercedes and Chrysler are calling another 150,000 vehicles. Tesla's had big recalls, but the two automakers will now be recalling 950,000 cars in
Mhm.
the US so far this year. This year, we're only in March, 950,000 cars. Looking at these automakers, it's not surprising if with all these recalls to cover, but all the money they're plowing into electrification is the concern. And this is what I think is depressing their valuations. Looking at Mercedes itself, it's now trading at the shares are trading at only 6.2 times forecast earnings. And you get a dividend yield with them of 6.7%. Mercedes, a fantastic brand value. Again, fears surrounding investment needed in EVs. And Volkswagen Group is even cheaper. Their shares are trading only under 4 times earnings, and you get a dividend yield of 7.5%. Not only that, with Volkswagen, you get the benefit of their 75% stake in Porsche, which is worth another 32 billion on it by itself, which is half of VW's market cap in entirety. So there could be a play there. Look, if you're interested in Porsche, you might as well buy Volkswagen, the
Mm.
company that is, not necessarily the cars. But yeah, it's just on paper they look incredibly cheap, but you've got to look at how much money they're plowing into building up their EV business, which has been absolutely huge and sucking in a lot of cash.
Yeah, there is a point to this question. I just want to contrast what we've just discussed there with the next company we're going to move on to. Are they both profitable? Which is a stupid question, Volkswagen and Mercedes.
They're highly profit. Yeah, clearly they're highly profitable.
Yeah,
They make real profits, even if
real
the cash is
cash.
going out, but real cash, real profits, and proper businesses with vast number of factories and everything.
Yeah, exactly. So there is a point to this. And the next company we're going to move on to is Reddit, which has just gone through a public IPO, which isn't even profitable, but yet is worth 8 billion.
This looks totally bonkers. So yeah, Reddit, I mean, it's good news for the IPO market. We're
Yeah.
starting to see new issues coming on. But Reddit shares started trading on the New York Stock Exchange at $50 a share they rose to. That's 47% up on their $34 IPO price. That values the business at more than $8 billion.
Hmm.
$8 billion for a company that has never made a profit, never made any money, and is still shelling out cash. Reddit's IPO has been on the cards for a while, and they pulled out in 2021, and they've come to the market now. But it looks absolutely crazy valuation to me. It just seems ludicrous to me. But at least there was an IPO, a second one this year, another one called Astera Labs rose more than 70% on its debut. I don't know anything about Astera Labs, but good to see IPOs, good to see new companies coming on the stock market because we're losing a lot. So yeah, good news and good luck to them. But yeah, 73 million daily users Reddit has, and despite 800 million in revenue, or most of it's advertising related, it has yet to turn an annual profit. Trying to make money beyond ads, but
How do you think there's 800 million in revenue, but yet to make a profit?
it's advertising. Clearly, it's getting the advertisers to pay up, given they want access to all those eyeballs of 73 million. But yeah, I don't know whether all the costs are going. I
Hmm.
don't know why, as the site is predominantly populated by users, a sort of social site,
Yeah.
I don't understand how they can make money. It's
Yeah.
bizarre.
I
And
guess it would.
it's a good point as well. A lot of these big technology groups made money very quickly. It wasn't as if they were loss making for years and years. The likes of going back in time, Microsoft, Apple, they were really super profitable from day one.
Hmm.
And we've had this trend of businesses not making a bean for a long time.
Yeah. Yeah, it's interesting, isn't it? And yeah, I suppose it would require a deep dive into where that 800 million revenue is going to find out why they're
Yeah,
not
yeah, yeah. It'll be an interesting one. I might have a closer look at it. You've
pricked your
suggested
interest.
consider. Yeah.
Should we move a bit closer to home, UK main market?
Yeah, sensible business. Next, shares also hit an all-time high on forecast beating profits. And this business, Next, the retailer, is so well run, fashion and homeware retailer. Chief Executive Simon Wolfson, that is a chap who really knows how to manage expectations. He's done a great job. They have also a fantastic discipline of using cash when they're doing share buybacks. They have a distinct formula they follow of when they should trigger share buybacks, and they've been doing that very successfully. And I tell you, it surprised me the inroads they're making in international markets. They've got a trial with Nordstrom, the US retailer, and they've also agreed terms with another US retailer. So could become more than a UK story growth play. There may be some international growth to go for now. But Mr. Wolfson has a reputation, as I read for it, or somebody said, of under promising and over delivering. And many chief executives could take a close look at that. And also the way they report, it's really good. Really impressed with the Next. It's a really the poster child of retailers, but in the United Kingdom anyway.
What is it that makes it so good?
They're very full and frank in their reporting. They're very timely in their reporting. The results are very open. They're not trying to hide things. They give you a clear picture of how business has been, how it might be. If it's bad, they'll tell you immediately as well. They won't try and hide and suggest all things aren't too bad. They say it says it very straight. And they've done this year on, year out. And they seem to know the market. They were actually in their online presence is clearly later, but they remember, people forget their directory business was ahead of the game. They had this Next directory for a long time before online took off. So they were actually very well placed to benefit from the growth in online retail.
Yeah, and sticking with retail brands, the next company is an absolute giant, or more of a conglomerate of companies, really, and that is Unilever. Unilever has a market cap of 98 billion in comparison to Next, which has 11.6. So this really is an absolute giant.
Yeah, Unilever, I think this is a good follow-on from Next, because for Next's clarity and efficiency and great management, Unilever, I think we hold Unilever both in our ultimate stocks portfolio and our income boosters portfolio. That's the Investors Champion one, and our firm fundamental as a long-term holder. It's a great business with great products, but I think you've got to question the management. So they've embarked on a growth action plan. I love the terminology, they give these things, the marketing spiel he comes out with, and they're separating their ice cream business and launch of a major productivity program. I love this bit about separating the ice cream business. They've decided that it has a very different operating model to Unilever's other operating businesses, including a supply chain and point of sale that support frozen goods, a different channel landscape, more seasonality, and greater capital intensity. With those factors in mind, why on earth did they buy the thing in the first place? An ice cream business is always needed sort of a freezer compartment. Hasn't that been the gist of it? Haven't they always needed a different supply chain? So what on earth possessed them to buy this business? It's not as if anything's changed. As far as I'm aware, it hasn't. Ice cream's always been sort of ice cream. The ice bit gives you a clue, really.
Yeah, what do they own? They own Walls, Ben and Jerry's. They're massive brands, aren't they?
So massive brands. It's a cracking business. 7.9 billion a turnover, this ice cream business. About 13% of Unilever's group revenues. It's around the world. 3 million ice cream freezers.
Wow.
I looked at that on their website. 3 million ice cream freezers it has to look after, and it puts into stores, and it has to maintain. It's a giant.
So is this going to become like a separate company?
I don't know the detail. Hasn't been given. They said they're going to separate it. What does that
Yes,
mean? Would it be
what
a
does that mean?
separate
Yeah,
listed
yeah.
business, or are the private or equity vultures going to descend on it and buy it out and extract it from Unilever? I hope it's listed. I think it would be quite fun to own an ice cream business. People are saying it's low growth. I bet if you stick a decent management team in with a bit of incentive, it'll spring back into life magically.
Because I'm just thinking here, is it a drag on the Unilever brand and the profits, or is it an actual one of their biggest profitable areas? And they're separating it out to really benefit from the profits as a separate organization, or
Well,
Is it a
No, they
drag?
won't, because that'll be the new shareholders. I assume they might retain a stake. So they're
Yes.
saying they're saying it's not growing as fast. The implication is not growing as fast as their
Right.
other product lines, or doesn't have got the desired growth profile. But and of course, the other thing that bugs me about this Unilever announcement is they're going to say they're going to make 800 million of euro savings over the next 3 years, but that's going to incur about, by my reckoning, about 750 million of cost to sort it out in their productivity program. And the way they report, they'll report the costs of restructuring as exceptional items. But of course, all the savings, there won't be exceptional items. So we're all supposed to believe what a wonderful job management's doing. Anyway, the stock market liked it. It drove the shares up. But contrast their communication and efforts with Next that we
Next.
spoke about. I think they're very different.
Do you think ice cream has the same appeal as what it once did in the 90s, early 2000s? We're going to show our age here.
I'm not a big eater of the stuff, so I don't know. I
Yeah,
don't know. Yeah,
I don't think it's quite got the same appeal that it once had, ice cream.
perhaps
It's
hit the nail on
yeah,
the head. That's why it's
yeah,
going to be low growth.
that's why it's low
Yeah.
growth, yeah.
I think they need to be a bit more creative. Clearly, where Ben and Jerry's was so creative and relative in the world of ice cream, innovative when they came out. It's not the case anymore, is it?
No.
You're right.
Yeah, and the issue with large companies as well, they become very bureaucratic, don't they? So it's difficult to make any really quick, innovative decisions. So maybe separating it out, that gives them the flexibility and the freedom to try new things. In a big
Yeah, I think so.
corporation, it's much more constrained, isn't it?
And Unilever's made some very odd acquisitions. Many of them have gone nowhere. And it does quite, some of them are ludicrous. Some of them you think, crikey, you could give a little team in Unilever a bit of money and they could have developed this within a few months. Yet they've gone out and bought something at a huge premium that didn't demand that much innovation and wasn't that different. I just think there needs to be more self-help going on, more dynamism internally. There must be some super bright people in Unilever and younger people as well that have got good ideas that they could all be harnessed.
Yeah, totally and absolutely agree. And I guess that leads us into the next company, which is innovative, it is nimble, and that is Hostelworld, which is doing quite well, isn't it?
We followed it with interest, and we hold the shares are fundamental. We've got a small stake in this Hostelworld, and it's a cracking little business. It's, as the name suggests, it focuses on the hostel market. It's an online travel agent in the hostel market, and it really seems to know that market, and it's developed quite an innovative offering via a social networking solution as well. So if you book through their site, you can start linking up with other people staying in hostels beforehand, both say in a city, and it's worked really well. It's helping them grow and helping them at a lower cost, because these businesses have to spend a huge amount on marketing. Travel is all about loads of marketing costs. If you can do it and attract customers at a lower cost through something else, great. And Hostelworld seems to be doing it.
Do you think they're a bit niche though to really grow?
They are niche. They are niche. It's a really niche offering. They got smashed during the pandemic, clearly when nobody was traveling. They've been carrying a lot of debt as well, expensive debt, which hasn't helped them. But you're right, their market, the universe, is quite niche. They would fit quite nicely, surely, with say, Booking.com, a giant, which is another one of our portfolio holdings, which is an absolutely fantastic business. Booking.com just ticks all the boxes in terms of numbers. It's a fabulous business. One of my favorites. And but yeah, so where can a Hostelworld go? How big's really the market opportunity? It should start getting to the point where it should be shoving off loads of cash. It's gone through its troubled period. Debt's come down. It's got this new nifty offering, which seems to be doing well. It should start throwing a lot of cash off, paying that back to shareholders.
Yeah, and you mentioned they're throwing off lots of cash. I guess that leads us into the next company, which isn't throwing off lots of cash. And that's electrical contractor T Clarke, which you want to talk about this one more like a lesson for investors and something to keep an eye out, which is remuneration package for the senior management.
T Clarke won't be alone, but I do think this highlights the problem. I think it's a real lesson for people in wanting to invest in smaller companies. This is a real lesson of things to be aware of and the problems why many people maybe put off investing in small companies. So T Clarke's a main market, it's not AIM, main market listed electrical contractor. It's a 65 million market cap business, which isn't very big, but it has big revenue. Revenues are quite high and very small margins. Profits fell just 7.6 million from 10 million in its last year. That's not the problem. So operating margins are tiny, its profitability is dropping. It had an equity placing to raise new money. It needed new financing, so it brought in 10.7 in new money. You look at the numbers here, unfortunately, a lot of that new money is going straight into management's pocket. There's very little left over for shareholders in this. So why would you want to invest in this business when the key management remuneration was 6 million quid, 6 million pounds? 80%, that's 80% of its operating profits is going to key management. And as I say, it won't be alone. This is a real problem with small companies, that the management of directors and key personnel actually consumes a lot of the profit. The big chiefs get the bad press, but often their big pay packets are pinpricks with relative to the returns that the business is making. Some of these small caps, the alignment is terrible with outside shareholders. Why would you want to invest in this business when management are sucking all the profits out of it before you as an outside shareholder will get a bean? There must be far better alignment really to profits, growth, earnings growth, the whole gubbins, rather than just them taking out such vast sums of money.
Moral of the story, isn't it? Look at the remuneration package of the
Yeah.
management.
Yeah,
Have a look at what they're
it's
taking out of the business.
I was shocked once. We had shares in a company on exchange views with another manager who had the biggest stake, multi-million pound stake. And I asked him, "Look, are you happy with the director's remuneration here? It's very high and it's never going down, however badly they do." And he said, "Oh, I don't know. How much do they get?" He did not have a clue what they were earning. Thankfully, we sold out of the company in question. I had enough, and the shares have done very poorly. It's one of those ones things we were right to get a few right, thankfully.
Yeah. Should we move on to AIM news? There's been
Yeah,
plenty of AIM
AIM.
companies, aren't there, to discuss here?
Yeah, plenty of AIM companies. AIM had a pretty bad February again, although it did welcome a new arrival. We had a business called Microsalt, sorry, not Microsoft. That would be nice for Microsoft to
Yeah.
join it. And Microsalt joined AIM. It's quite a small company. It's commercializing a patented technology to produce full flavor, low sodium salt. Sounds quite good. It raised just 3.15 million quid at 43 pence a share, and the shares swiftly climbed to over £1.15. So
Wow.
people like this.
Yeah.
They're now at about 80 odd p, so they're still well above the IPO price. And well done to Microsalt. Welcome to AIM. We hope you have great success.
I wonder if people are mistaking it for Microsoft.
Probably. There's probably no accident behind their name, is there?
Yeah,
It went
that's
for
what I
it.
was thinking. Yeah, that's what I was thinking.
They're
What's
probably going
the
to get some litigation soon from Microsoft.
overall value of AIM now? It just slightly declined again, hasn't it?
Yeah, it fell back to 76 billion at the end of February. That's all the value of all AIM companies from 79 at the end of 2023. The number of companies as well fell again to only 742. So this is a fraction of where it was back in 2007. There were 1,700 companies on AIM, and there was a lot of rubbish. But now we've got far fewer companies, a lot of good ones, a lot of really nice businesses on AIM, profitable, attractive cash flows, decent growth profiles, but we need many more of them. So we need many more IPOs needed.
Yeah, and at the other end of the scale, from a company that just IPO'd, such as Microsalt, we have M.P.Evans Group, the producer of sustainable palm oil, which has roots as far back as 1870. Can you believe?
Yeah, look, this is the other end of the scale to Microsalt. It's a very well-established business. It used to have oil plantations in Malaysia. Now it's Indonesia. And the focus now is on sustainability. Clearly, it's a bit of a controversial product, palm oil. And M.P.Evans is trying to be a responsible grower. It grows a lot of its own stuff, produces a lot of its own stuff, and it also processes other people's produce. But yeah, this is very much less of a growth play, very much a dividend yield play. The dividend yield is over 6%. Free cash flow yields 8.7%. It's trading at under 10 times. It's using excess cash to buy back shares as well. But yeah, it looks in really good shape. And if you like your dividends, there are worse places to go in the small cap world. M.P.Evans is seemingly quite assured.
Are they in the
They're
fundamental
trying to.
asset?
Yes, we hold in our higher income fundamental high yield portfolio as well. Fundamental runs an AIM, dedicated high yield AIM portfolio, and we hold M.P.Evans as well. And yeah, there are growth aspects. They're planting more and more palm oils plants, and so hopefully they're building for the future, but it's not quite as racy as people would like, at least for a small cap stock anyway.
What about U Group, the independent supplier of gas and electricity?
This has been an incredible recovery story, this stock. The shares, it had a near-death experience a few years ago when you had the energy sort of bubble and things were going all over the place. And it really, the stock's up, I don't know, 20 times more than that since lows. It's now become quite a sizable business. It had a fantastic year. Revenues up 65% to 460 million, earnings up 500%. This is unbelievable from a lower point. But it's also had a bit of a break because it doesn't have to lodge as much cash collateral for its hedging. It's got this new deal with Shell, which says that you haven't got to lodge collateral now. We're happy with the way you look, your system, so we rely on you. And that's relieved it of a big cash burden. So yeah, U Group, the question is, can it keep going? Founder owns 52% of the business, Bobby Callar. He owns 52% of the company. So that means the shares aren't as liquid. If one bloke owns that much, and another institution owns a big chunk, not many shares are traded, so it doesn't take much to move the price higher. And should things fall out of bed, it won't take much to move the price lower. The valuation on many levels looks still dirt cheap. It's trading at a single times earnings multiple, and forecast growth is still stunning. Can it continue? Will the changing energy landscape mean that growth will be more of a struggle? People won't be changing. The bad debt risk is big as well. If it has a big bad debt, it's got a tiny balance sheet with nothing really on it. It could wipe out a lot of it in quick time. So more positively, it's done it. It's been amazing recovery, and congratulations to people that held this one through the dark days.
And one that many private investors will be quite familiar with, Jusges Scientific.
Yeah, this has been a very popular stock for AIM investors, and management done a great job communicating. A bit like our friends at Next, the senior management at Judges have always been willing to go in front of retail investors, institutional investors. And since listing in I think it was 2003, it's delivered a 11,000% growth, and that excludes the dividends. Absolutely fantastic. So it's been a huge AIM success story. The shares have always looked expensive. They've just done a big acquisition. Well, they did a big acquisition a year or so ago, which was the costliest acquisition they've ever done. But the shares look very expensive. And those are on an adjusted basis. If you take out the adjustments, they look even more expensive. But yeah, who would bet against it, given the delivery today? And it's a very nice business. 700 odd million market capitalization now, and seemingly still more growth to go for. But am I a buy at these levels? It's a bit of a struggle given the way the shares, where they stand, the valuation assigned to it. I think there's better value elsewhere on AIM, immediate value seemingly. This one has been such a great performer that you can't write it off.
What about Focusrite, the music audio products group?
This is a sort of local favourite. Its headquarters isn't far from us, High Wycombe in Buckinghamshire, and it was a great stock over the pandemic. A lot of people were buying their own recording stuff, and so its main business benefited really nicely. It's also acquired more and more audio products companies, so it's now got a bigger portfolio. It's got a software bit as well. It's got synthesizer stuff, and it supplies both the consumer, the DIY musician and audio producer, also to business, for corporates and businesses as well. But yeah, it's really fallen out of favor, struggling. Its main Focusrite brand business and Novation business are both struggling a lot. Struggling is not the right word, but growth isn't as it was, and it put out another profit warning this week, and the shares have now fallen back massively. They've now lost circa 80% of their value since the pandemic highs, which is a shame because they're a really lovely business, does good things, interesting products, growing your product portfolio, which is great, so it can sell more through its distribution, more product through its existing distribution channels. We think it's hopefully just a short-term blip. It hasn't stopped acquiring other businesses as well. So despite the shares are on the floor, it's using its cash to acquire other businesses. And hopefully it could be, again, much like U Group was down and out. All right, U Group more to a greater extent, but Focus could be a decent recovery play. And we're staying faithful to them. We think the shares look cheap at current levels.
Is that in the fundamental portfolio or the IC?
We've held it for a long time, the fundamental portfolio. Yeah, we held it from not long after IPO. I remember going to visit them in High Wycombe. I visited their premises. I was very impressed with what they're trying to do. I think they overpaid for some acquisitions. They paid at the height of the market. That wasn't good. But looking at them, all the businesses acquired have gone on to deliver pretty good growth under Focusrite's ownership. We're holders. I personally hold the shares, and I'm interested in buying some more at these levels.
So we've had a question come in, and one of the questions was, can you explain what a stonking small cap is? So when they see it, they know why they should take interest in it.
Stonking small cap is the name we've given to a small company that is growing fast. And when we say growing fast, it's doing at least double-digit top-line growth. Not three earnings, but its top line is growing at double-digit. And we call it a stonking small cap. So in a nutshell, it's a very fast-growing, smaller quoted company. Typically, it will be on AIM, and it might be on the main market if we can find one. But I think all of them now are on AIM. And some of them one of them announced, or two announced this week, fantastic results. One has been a consistent performer, and it's actually due to move to the main market. I won't give any names away at the moment, but it's been a fabulous performer, really fast growing. The other one has only just turned profitable, but again, growing very quick. The other one is really benefiting from utility operators, sprawling networks. You wouldn't believe how unplanned everything has been. This company has a software solution that helps utility operators plan their networks more efficiently. You're not digging up the road here, there, and everywhere. And they operate both in the UK and in North America and in Europe as well. And they've had a terrific performance. We've just written up on a new stonking small cap, an unusual business which provides a service to stock markets, stock exchanges, and it's performing really well. It's always really impressive when a business is still growing in the face of an adverse market. So even if its market's challenging, but it's beating that back and still generating decent top line growth is really always impressive to us. And this one is also profitable.
So out of the three companies there, can we share one name?
Share the first one is Alpha Group International. We've held this business in a fundamental portfolio since not long after IPO. It's now a 700 odd million market cap business. It's due to move from AIM to the main market, which is a shame. AIM's going to lose an absolute fantastic business. But it's another one that in the depths of the pandemic had a bit of a mishap, an issue with one of its customers. It was facing a huge bad debt, and it's got through that, tightened up its risk control, and it's been flying. It's making a mountain of money now from interest on deposits. Whether that would continue to such an extent is unclear. It's investing still a lot in new products, new services, new offices around the world. Its core business was in currency hedging, and it's now moved to a so-called alternative banking area as well. So yeah, it's been a great advert for AIM, and it'll be sad to see it leave.
And the other two companies, there's plenty of articles on Investors Champion.
Loads of articles there. We've all covered them for a long time.
Yeah.
And it's been a stonking small cap now. No, stonking small cap last year we made it, but the latest one has also got some good coverage there for people to read.
Yeah. What sort of information, just out of curiosity, so that people can be aware of what they're looking at?
A lot of background, also a little bit of history, shareholders, when it joined AIM, what the performance has been like, coverage of the recent financial results, a real deep dive into those, and thoughts on the valuation as well. It's one of them. There's no accident on paper that, initially, if you look at them, the valuation looks pretty punchy, but you've got to consider that relative to its growth as well and the visibility of earnings. So we go over all the elements, look and introduce the management as well. The most recent stonking small cap is still founder-led. So the CEO is the founder of the business, which we love, and he's got a decent stake in the company as well.
Yeah.
And a good dose, hopefully, of common sense. It's often a lot of common sense, and you've got to look out. It's harder for a layman to understand, or a layperson to understand the market dynamics of some of these companies if the market's very specialized. That can be the problem. I think financial services is a lot easier. A lot of us are immersed in financial services, and the UK actually is quite good at financial services business. It's a bit of our niche, and some of these are really quite good. Alpha Group is one such business in the financial services sector that's done well.
Yeah, brilliant. Absolutely brilliant. So again, as we've said in the previous episodes, investorschampion.com if you want to learn more about what we've just described there and enjoy some of the great articles that Chris and the team write, then please just click the link just below in the show notes, and happy investing.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode, as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.